Hello, welcome to another episode of the Stay Invested webinar series, our client outreach series featuring in-depth, honest talks about real estate and property management. We hope everyone's having a great fall, enjoying the football season or other fun fall activities. Fun fact, Jeremy and I's alma mater, IU, is doing really well this year in football, ranked number 2 in the country. So we're definitely excited to watch that play out the rest of the season and looking forward to the postseason, first time in my lifetime at least. So,
Yeah.
but yeah, as we prepare for the holidays, Christmas and Thanksgiving coming up, I think it's a good time that we start talking about wrapping up the year and looking forward to 2026. So we have a strong year next year. Today, we've gathered an expert panel of real estate and property management experts to kind of go over this topic. So without further ado, I'll introduce everyone. We'll start with Chris.
Yeah, my name's Chris Aaron. I'm the director of client services here at T&H Realty. I'm also a real estate investor. That's how I got started. And today I'm actually sitting in front of or in one of mine as we go through the last part of the BRRRR strategy.
Awesome. All right. Next up, we have Matthew.
Hello, my name is Matthew Long. I'm the accounting manager here at Teenage Realty Services. Really excited to be here.
Great. And finally, not least, is Jeremy Tallman.
I'm Jeremy Tallman. I'm co-founder of Teenage Realty with Scott, and love talking investing, love investing, and excited to be a part of this webinar and talk real estate.
Yeah, we've been doing business together for 25 years. It's kind of hard to believe.
Right.
Back when I didn't have any gray hair, and maybe you had a little more. I don't know.
That's exactly right.
All right. Well, we'll go ahead and get started here. Review today's topics. We're going to talk about year-end accounting and tax preparation, and then move into kind of once you get all that information, taking a look at it, reviewing your performance of your portfolio or your property, and then move into maybe planning next year. And then we'll wrap it up with kind of a summary and year-end checklist that we'll give. So first, I thought it'd be good to, as we start counting down to, the end of 2025, there's going to be a series of things that will happen. And I thought our accounting manager, Matthew, would be great to kind of go over what we do and what you should look for and when that happens. So Matthew, take it over here.
Yeah, thank you, Scott. I love this time of year. I love wrapping up the year, looking at the performance. So really excited that we're able to walk through this with you. So first thing is obviously, from a legal standpoint and just, required here, but we will be issuing 1099s, of course. Those will be issued to you prior to January 31st. So keep an eye out on there. Luckily, the IRS is very generous. They have an interesting time period. We have to issue it to you by January 31st, but we don't have to get it to them until March 31st. So that window right there is a perfect time to be reviewing all of these documentation. One of those big things you want to be reviewing is your annual owner statement. So we issue statements on or around the 5th of each month. December will be no different. We'll be issuing December's statement in January, around January 5th, and then an annual owner statement. So that'd be the whole year. All of 2025 will be issued there about the same time. January 5th, January 6th, you will receive an annual owner statement. So this document, just one thing that I always want to just right off the bat, when you see that 1099, just remember that number you're going to see is the gross amount. Your owner statement is going to net out a lot of those expenses that we are worried about with, maintenance, turnover work, management fees. Those are all going to be in your owner statement, but that 1099 is going to be gross. So that's going to be the top line number before any expenses are taken out of. So keep an eye on that. Don't forget that. Make sure you're looking at the right line on your owner statement when you're comparing it to your 1099. Also on the 1099, I want to point out there's two boxes that are going to be most important for us, which is going to be your box number 1, which is going to be rents, and box number 3, which is all other income. So keep an eye on those boxes. Most owners are only going to see income in box number 1, but some owners will see income in box number 3. So keep an eye on that. Like I said, those will be on your 1099, and you will also see those gross amounts on your owner statement. Just generally, I want to talk a little bit about expense reconciliation categorization. Owner statements, annual or monthly, are not tax documents. These documents, these owner statements, need to be really read and put into schedules by qualified tax professionals. So make sure you're looking at that. Just know that you can't take our owner statement and immediately submit it to the IRS. It's not going to work. Schedules have a lot of different items, repairs versus maintenance versus improvements. Those are all really important categorizations that our owner statement doesn't really dive into. So just make sure you're keeping an eye on that. And additionally, there is a lot of other expenses which we don't pay on your behalf. Those could be insurance, HOA dues, mortgage interest. Those are all items that aren't going to be found in your owner statement that are still going to be really important for your year-end close and your tax documentation. So again, make sure you're talking to that qualified tax professional. Everyone's tax situation is so different. I don't want to give anyone any sort of direct advice other than talk to a qualified tax professional. And then lastly, just making sure that at the end of the year, you're looking at, is there expenses that need to be made sure to close and book into 2025 before the end of 2025? Are you getting close to a turn? Do you have a major repair that needs to be done? So make sure if your property manager is reaching out to you or our maintenance department asking for repairs or turnover costs, make sure you're looking at those and approving them as quickly as possible so that we can get them booked into 2025. It's most likely going to be in your best interest to get as many expenses into 2025 as you can. And then lastly, that period, like I said, between January 31st and March 31st on your 1099 is a great time to reviewing those amounts and making sure everything looks correct. But if you have changed your property's ownership structure, have you moved it to a trust or moved it into an LLC, we need to know that before January 31st so we can make sure we get your 1099 with the correct social security number or EIN. So please, if you have updated your ownership structure, make sure to send us a W-9 as soon as possible. We could take it as early as today so that we can get your documentation updated and correct in our system so that January 31st, you get a 1099 on the first try with the correct information. So if any sort of ownership structure, please make sure you're communicating that with us through your PM or through the owner inbox. We would love to make sure to make those corrections as soon as possible. And the last thing I just want to mention, just with year end, as always, holidays are a big deal. So make sure you keep an eye on our holidays. We'll issue distributions as soon as possible. Luckily this year, Christmas and New Year's is on Thursday, so there shouldn't be any disruptions to draws. But just making sure, keep an eye on that. Obviously Thanksgiving will affect that. So make sure you keep an eye on distributions and our holiday schedule. But that's all I got, Scott.
Yeah, that was thanks for that, Matthew. That's a lot to unpack. But yeah, you bring up a good point. First of all, I want to congratulate you. I mean, you set for the CPA exam recently, and even though you're not official yet, we hope that next year you'll be a newly minted CPA. But you made a good point. We're not tax experts. We can't give anyone tax advice. Our job is to provide the details and provide the documentation to help you have someone or you prepare yourself your taxes. But 1099's quick summary here, that's your gross income only, and that's given to the IRS. They want to know how much money you made in this venture. Your expense side, that's handled on your income tax statements through various different mechanisms. If you're like a self ownership, you're going to have Schedule E, and if you're like an LLC or LLP or any other, even a sub S or even a C Corp, you're going to have other documents like a K2 or something like that. It's going to flow through your personal income. So those documents are all prepared from the gross revenue you received and then allocating all your expenses against that to produce a net impact on your income. So our job is to give you as much detail as possible. You're going to have statements. You're going to have source documents in your portal. You can, download and get all those data as you need it from our system, hopefully. So, Jeremy, Chris, do you guys have any additional points you want to make on just the documentation and how that works?
Say this. I think we've talked a lot about this, but if people are out there listening to saying, well, I'm planning on doing my own taxes this year. I just bought a rental, I'm planning to do my own taxes. I would really push back against that idea. I think hiring a CPA makes a lot of sense in almost every single case. If you're a CPA and you happen to own rental properties, okay, you can do that. But if you're not, and I'm guessing almost all of our clients are not, I would strongly advise getting the help of a CPA. But beyond that, make sure it's a CPA that is well-versed in dealing with rental properties. If you need recommendations, let me know. I just did a podcast with a guy out of Minnesota. He was fantastic. This is his main source of business. He does tax returns and tax advising for real estate investors all over the country. So this is complicated. It may seem a little, it's a little thick and a little mundane in some ways, but I would highly encourage you to do what you do best, find new properties to buy, grow your portfolio, but let the tax stuff, let an expert handle that. I think they'll pay for themselves in many cases.
Yeah, and I think, that touches really well on things we've seen and felt from clients that have tried maybe a different route. Something I would say too is, we're going to signal, we're going to send out reminder emails. So keep an eye on your emails. We'll give you the timings of when things are coming out and whatnot. There are three full dates that really we see a heavy volume. That's going to be right at the end of the year. People are asking questions. They're starting to think about it. Maybe they got that extra time with the family and whatnot. And then coming up on January 31st, we're starting to get a lot of people asking if they haven't seen things already they were expecting. They're going to be asking us for those, or maybe they received them a few weeks ago, weren't looking for them, didn't realize where to find them. March 15th, April 15th, those are dates as well that we're going to see a surge in volume asking for those things. And also, one of the things we experienced last year was a lot of people reaching out saying, hey, I'm at my CPA and I need this document in the next 30 minutes. And we might get that on a Saturday, and we're not open on a Saturday. So my advice to you is, please, if you get those communications, set them aside, have them somewhere where you can reference them and anticipate what you might need maybe a week before that deadline or that meeting with your CPA, and ask us then. It's a much better chance of you getting what you need when you need it.
Well, that's great advice. Yeah, we definitely want to help as best we can, but yeah, sometimes it's almost impossible where it's just too much to handle. So
Yeah,
planning,
the volume
don't
is a lot.
right. I mean, planning is key, and don't procrastinate. As tempting as that is, don't procrastinate. So, all right. Well, yeah. So you're going to get a lot of data and a lot of information in the next, 2 months. So after you get that, what do you do? And yeah, maybe you hand it off to your CPA to do your taxes. What do you do on your end as an investor? I think the next topic we want to kind of go over is I think it's a good opportunity, since it's all fresh and we got new data and you got a whole year's data potentially, is to really take a look at how everything went and really look at, a couple different factors here. And to see how your performance went with your property, or if you have more than one property, your whole portfolio. But yeah, I think we have a couple key questions here. Is how did the leasing go? Your occupancy rate. You can look at your expenses and things that happen throughout the year, as far as like your maintenance cost, your make ready costs, or other capital improvements. And then after you have all that kind of an understanding of it, you can do some calculations and run some analysis. So Chris, tell us a little bit about some of the key factors of each one of these areas that we should look at.
Well, it's a great place to start is the leasing and occupancy of your property. So what we're looking at there is we want to look at total days vacant and overall occupancy rate, resident renewals, any of rent adjustments, whether pricing and marketing is aligned with the market, and how quickly the property leased once listed last time. Leasing and occupancy drive a huge portion of your year's performance. Solid renewal or a well-priced listing can have an outsized impact. Then we're looking into your maintenance, your make ready, and your capital improvements. Just to kind of summarize what make ready means, that means when your property went vacant, the repairs that we did during that time frame. So as we look at that sort of stuff, the key points there are to separate those one-time repairs from recurring issues. You really want to identify, hey, is there a theme to the repairs or the problems that I had in the past year, the repairs I had? And what we're trying to do is, we're trying to identify aging systems that may need replacement soon. We're also going to consider how improvements have supported the rentability, and or if we haven't done that, if we deferred maintenance, how that's going to reduce, rental rates or things like that. But and really, what we try to do is we want to try to minimize the issues. Something that we've really discovered this year, there was data supported from an industry partner, is that deferred maintenance, delayed maintenance, slow to repair things has an impact on the chance that you're going to renew the resident. So we really want to stay. Those repairs are incredibly important. And I know it feels expensive in real time, but this year-end review is going to help you spot patterns and decide what needs attention versus what was just, I guess, for lack of a better term, noise. Then the third part we're looking at here is cash flow ROI, which stands for return on investment, and ROE, which stands for return on equity. We're going to kind of compare our cash flow year over year, measure the ROI, the return on investment, using a full year lens, not the individual months. And then we're also going to consider the return on equity as our equity grows. If your equity is increased, but your cash flow hasn't, it may be time to evaluate whether or not this asset still fits your strategy. And when you're looking at cash flow, ROI, and ROE together, it gives you a much clearer picture of the property's overall performance. And finally, I'm to kind of sum up here, everybody's their investment plan is different, and there are multiple things that you should be looking at. We call it the 5 profit centers. There is a blog on our website that I think is a really good one to look at if you haven't, or if you have, it's good to refresh on it. But investor success is more than just cash flow. It's principal pay down, it's appreciation of the property, the tax benefits, and there's an inflation hedging component there. So look at those 5, see how that fits your long-term strategy, and measure your property against those.
Yeah, that's a lot of great information. I think, a lot of people just focus on cash flow only. I mean, I think they want to get a certain amount of money in the mail each month. And I think if you're a seasoned investor and you think about it from a global aspect, there's much more, like you mentioned, there's much more to it than just that. And I think we can get wrapped up in the cash flow part. Obviously, it's important, but it's not the only part of the full return. I think another thing you should look at is if you had higher, because you're going to have expenses. I mean, you're running a business and you can't run a business without having expenses. So things will break, there will be maintenance, that type of thing. But if you look at your yearly burn rate on it, and if it's above a certain threshold, then I guess that could be a valid question. So why is it higher than it should be? And this is an opportunity you can look at that. And Chris, you kind of nailed, the main reason that usually happens is age of equipment, other factors in the home that are causing it having higher than average maintenance. So this is an opportunity that you can take that information that happened to you in the year, and then you can use that to make your plans going forward and maybe try to adjust that. And then there's other factors, outside of what we do, insurance rates, property taxes and things like that. You can look at that, review that, how that went for the year, and see if there's any adjustments that need to happen. I mean, obviously you can't change your property taxes, but I mean, I guess theoretically, if you thought it was over assessed, you might be able to appeal it. But the main thing is to look at, maybe you could shop insurance rates around, or you can lower that premium cost, etc. Jeremy, I mean, I thought this would be a good time to maybe, if Chris went over some great things, but I know we do some analysis. We look at our numbers each year as well for our portfolio. What are some important takeaways that you feel like owners should consider?
Yeah, something, just kind of a ritual that you and I have gotten into every year is we have a big spreadsheet. And you mentioned before, we've owned rental properties now for more than 25 years. So I'm guessing that spreadsheet is around 25 years old now. It's went through many, many different versions of Excel, I would assume. But something we do is we update I think you go in and update loan values. All right. And then I go in and update market values. And so I don't know if people know this. Like we have 40 some doors that Scott and I that Scott and I own together. So it's an exercise, right? And so it's we put thought into it. I mean, Scott basically just transposes numbers from a sheet or whatever the loan balance is with a sheet. But I will do some market analysis. Some of it I kind of know because I look at listings every day. Some of it I do have to go in and look, but that's a great exercise because really cash flow has never been a thing that Scott and I based our investing on. I think we're very much on record with saying that over and over again. We've never taken money out of our rental business. It's always just been reinvested into it. But when you look at it over time and you do that exercise every year, you will see the great power of long-term investing. And that is your loan balances go down. They may not go down a lot in the first year. If you get a 30-year loan, I understand there's not a lot of payoff there on principal initially. But as you own this real estate, those loan balances continue to go down. And then the real estate values continue to go up. So the delta, your equity there, should increase significantly over time. And that is so much more powerful than any type of cash flow you would ever get off your property. I know you have to create fuel to run the engine. There has to be some money coming in every month, but it's not something I think should be the focus of investing. It's really about gaining equity. And that's done right, wrong, or indifferent. It's a long-term play. And that's how we've always looked at it. Something else, so I would highly encourage you to create that sheet. If you have one property, it should be super simple. We can help you in creating comparative market analysis if you need to get an updated value. Our brokerage team is more than happy to help you with that. The other thing, though, I always recommend to people, and this is something Scott and I do every year as well, is we create a personal financial statement. And I'll create one, let's say in 2025. Well, in 2026, I'll create a new one and I'll create a separate document. So it's fun to go back and look and to see the wealth building that happens year over year, every year. Because something I'll propose to people, and this may sound odd, but I would propose it to you. Let's say you get your year-end statement this year and you do all your other calculations with your mortgage and taxes and insurance and things like that. And you find out you lost $5,000 in cash flow this year. Okay, that doesn't sound great. But then I would also take that further and look at your market value and look at your loan amounts. My guess is it will be a multiple of that loss, meaning you will have gained back a multiple from that equity appreciation. So, if you just get a 5% appreciation on a $300,000 property, that's $15,000 in pure appreciation. You probably paid down several $1,000s. So let's say $20,000 you gained in wealth that year, but it cost you $5,000 in cash flow. So you made $15,000 net. That's a pretty good deal in my mind. So really focus on that bigger picture aspect because that's where wealth is generated, especially in the single family space.
Yeah, that's great information. I think, even if you paid cash for that property, that's not a bad return. But
Right.
if you got a loan and you only put 10% down or maybe even 20% down, that's an amazing return on,
Yep.
for example, $60,000 investment. So on a yearly basis, making $15,000 on a $60,000 investment. So that's the power of leverage, and that's one of the unique factors that real estate can do for you. And then you use other people's money to pay down that loan balance, and that delta increases over time.
Yep.
So that's awesome. That's great information. Matthew, do you have any points to make or any other advice as an accountant that we should take into consideration?
Not a ton. Jeremy hit it, just absolutely correctly. I just want to reemphasize again that owner statement is the starting point for that sheet. We're looking at that's gross rents, but there's so many other factors that you need to utilize. So that using your own spreadsheet, there's plenty of software options out there, but even just an Excel spreadsheet is an absolutely fantastic way to get a lot of that reporting done so that you can really review your investment.
Yeah, I think, having information is the power. I mean, you have to, if you don't know what's going on, then yeah, you're just going to operate off emotion. You're going to get a phone call saying you had a furnace go down, and that's all you're going to remember. But if you look at it on paper and you see the results, you're going to feel a lot better about it. Because I mean, it is truly, unless something drastic happens, it is generally, it does pay off. And, there's a lot of great upside to real estate investing. It's just not only cash flow. So, well, now that you did some analysis, you ran these reviews. I think it's, that moves into the next topic here is what to do for the following year. Obviously, if you didn't have any vacancy or any leasing this year, there's probably a higher probability you're going to have that coming up. Um, and that's always subject to, that's a painful period when you have vacancy and your tenant moves out. So we do take a lot of effort and we work hard to minimize that as much as possible. But it is an opportunity to kind of anticipate that, think about the leasing factors that are going on right now and rental rates. You can also talk about budgeting and planning for expenditures. And then, if it's a time that you want to either dispose of that asset and replace it, or dispose of it and get out of the business entirely, or hopefully grow your business and get more into it, it's an opportunity to look at those opportunities and try to make a plan to make that happen. So I think the next area that we'll go over is kind of some of those key factors for planning. Um, I know that we've done some podcasts and some blogs recently about the rental market. We keep our fingers on the pulse of that. The rental market for this next year, at least in the early part of the year, is probably going to be primarily the same as it's been lately, which is it is kind of softening a little bit overall, and it's not as hot as it used to be during the COVID and post-COVID, immediate post-COVID period. But it doesn't mean that people aren't moving. I mean, we are seeing people move every month. Rent rates are still going up, just not as at a high pace. So I think one plan, if you're looking at, what are you getting for your property, modest increase is probably what you should plan for, somewhere in the 3 to 5% range. The days of the 10 to 20% is probably not going to happen, at least for this next year. But we'll give that information month by month. We're committed to staying on top of that and making sure we share that information with our clients. So when you do have a vacancy, you have the fresh, accurate information to make the most immediate answer to that. But if you're going to be projecting for this next year, again, I would recommend just taking a modest increase in your rental rate next time a lease is up for renewal or there's a new lease generated for the property. Chris, why don't you kind of go over? I think you've been a big proponent in our company about budgeting and planning expenses, talking about routine things and also CapEx expenditures. Kind of give a little bit about that, your point of view.
Yeah, that is something I've been preaching this year, is capital expenditures and operating expenses. I think everybody understands operating expenses. When you're doing your deal worksheet before you buy a property, you're probably budgeting for things like, turnover and vacancy and your taxes and all that stuff, the day-to-day things, the things that you generally expect. The piece that I have seen that people aren't really always putting into their plan and their long-term planning for their property is capital expenditures. And those are the big painful things. When we hear pain from clients, it's because they got to replace a roof, a furnace system. I had to replace my furnace this year in my own home. I spent 11 grand. That is a big impact. And if I'm just looking at that cash flow for the year, I'm measuring against that, I lost a ton of money, is the way it looks. But in reality, if I actually spread that over the expected lifespan of that device, so in this case, the furnace, I expect a furnace is going to last 20 years. Comes down to a little over $500. I didn't do the math for this, but a little over $500 a year is what I've got to save to make that replacement cost. And that is really the difference sometimes that I've seen between investors that are successful and new investors that are caught off guard. And it's because they didn't make that anticipation. And they're just like my wife and myself. We were hoping that furnace lasts another year, and so on and so forth. My furnace is was fully, 24 years old before it finally conked out, and it conked out at the worst time of the year. It conked out in August. It was actually, so it wasn't the furnace, it was the air conditioner that was missing, That is something that what we see in the rental environment, I touched on this a little earlier, is that if you don't make those repairs and you disrupt your residents, that's where the chances can drop significantly, as much as 70% on whether or not that resident's going to renew. If you have two big problems and you wait, then they're cold for a week or whatever it takes, that's when you've probably lost that resident. So my advice to our clients is replace that system on your terms. Don't wait for it to tell you when you're going to replace it. Plan for it. The best time, if you got a vacant property and your furnace is 18, 19 years old, probably the best time to go ahead and replace that system. Same thing with roofs. I've got clients right now, even today, that we're talking about, replacing a roof. A roof is, 10, 12 grand, maybe something like that. So really, something that we've implemented this year in the client relations department. So this is your property managers in the department we call the client relations department. What they're doing is we've begun an outreach program earlier this year. And so they're sending out emails at a certain time of the year for you, reaching out and saying, hey, let's meet and let's talk about your portfolio. And what we've been doing is we've been gathering information. You can see it in your portals in some cases already, where you have, things like your furnace age, your water heater age, your appliances, things that we really feel like you should be watching and replacing proactively rather than reactively. And we're also, if you have that information about the age of your roof, we're talking about that as well. So watch for that. Watch for that email that comes out from our client relations team saying, hey, we'd like to meet, and take them up on it. It's a great time to talk about it. They're prepared to do that. But those capital expenditures is really the piece where I feel like some people just miss the mark.
Yeah, that's a great point. What's kind of unpacked that a little bit, I think if you have an example of, say you get $1,000 a month in rent and our management fee is $100, that means the gross is that you're going to receive, the maximum potential would be $900. But chances are you're not going to receive that month after month for 12 months. You're going to have things that happen. And, I think that we may want to spend a minute here as far as like, first of all, you might have some vacancy. So you're going to have to reduce that maximum potential by that factor alone. Then you're going to have expenditures like maintenance. And, you're going to have maintenance. It's just part of owning a house. So you need to plan for a certain percentage. Chris, what do you recommend someone budgeting for like a normal maintenance expenditure?
That's really going to depend on the age of the property. In my experiences over the years, what I've found is those properties that are older, the ones that are pre-World War II, tend to have higher maintenance needs, higher maintenance costs. And, a few years ago, we were saying 15%, for something that old. And honestly, with material costs and labor costs being what they are, it's probably a little higher these days. But the general rule of thumb has been 10 to 15%. If you've recently done a really good job of repairing a property, you've done full remodel, like this home right here, we've pretty much full remodeled it. We know what hasn't been replaced, and so it's very easy for us to budget and anticipate that we're not going to have a whole lot of, knock on wood, whole lot of repairs this year. That's where you're going to start. And then, so that would be like kind of your turnovers, your operating costs, things like that.
Do we lose Chris for a second, or is it just me?
Yeah, I think we lost Chris.
Okay, well, I agree. I mean, I do think that, at a minimum, you got to look at budgeting 10%. But as the age of the house increases, or the effective age, really, because I mean, if you have a recently rehabbed home, you can probably put it in a category of a more newer construction home. But if it's an older home that has not been rehabbed, then you're going to have to factor more, unfortunately, as much as 20% in some cases.
Yes.
So in that case, you're not going to have that every month, but it doesn't come in a perfect schedule. It's not going to give you 20% reduction each month. You're going to have 1 month where you're going to have 3 things go wrong, and then you might go 3 months where nothing happens. So it's just on a yearly basis. You want to take that average percentage and budget that. Now, we do our part to try to minimize that, and if it doesn't happen, then that's a bonus. But generally speaking, you need to kind of mentally prepare and financially prepare for that type of effect on your net performance. Then there's going to be other factors. Obviously, we don't pay every expenditure that owning real estate has, like property taxes, interest, insurance. Those factors, you can put a P&L together, and you can see what those costs are and how that affects your net. At the end of the day, you hope you have some minimal cash flow to build up your reserves for those one-off issues, and especially CapEx type of planning and expenditures that you might have to plan for every 10 years. That's why, Jeremy, you said something earlier about how we never took money out of our business. We let that money sit in our business, and it supported itself. So we don't have to keep on putting money into it. If you have one property, that's really hard to do. But if you have more than one property, you can build a reserve with that cash flow. And then you have that buffer to ease out the ups and downs of real estate investing. Jeremy, do you have any additional thoughts on that, or?
Yeah, I think, I did a video earlier, maybe 2 months ago, that you and I had spent $40,000 in HVAC in the first, I think, 7 months of the year. So it's real. I mean, and we have old homes. I mean, we have our home. I don't know what the average age of our homes are. It'd be kind of a fun thing to look at. It's probably about 100 years old. We bought a lot of homes that were built in the 20s. So it's expensive. And, our maintenance costs are probably running, I quoted it actually in the video, but it was, I think, over 25%, I believe, because I did look at it. I went through our statement and year-to-date statement and came up with that. So it can be very expensive, and we're in a market now where things cost more. And so we have to budget for that appropriately. And it takes recalibrating those old. If you go to a Bigger Pockets post, let's say, for example, that was written 10 years ago, and they say budget X maintenance, we'll add something to that because that is old data. Because unfortunately, rents have not kept pace with the cost of construction and materials. So we just have to think about maintenance differently now.
Yeah, I mean, that's a good point. I mean, we had a very high burn rate this year. We knew it was in one of those cycles where, you have those 10, 20-year cycles that hit. And now that a lot of our houses, I mean, we first started 25 years ago, but a lot of the houses we bought 20 years ago, and those are starting to need second furnaces. And that's not something that is going to happen every year, but when it does happen, you need to be prepared for it. You can, I'm not giving tax advice here, but you can also think about how that affects your basis points on the acquisition costs of your home. Some of that could be capitalized, and you might be able to not have that be like an expenditure entirely for that 1 year, and you can just depreciate it out. So, there are things you can do, and we always advise you to talk to a tax professional about that. But you can reclassify what we call expenses, and you can rebalance that on your balance sheet and maybe have that have a positive effect or a different outcome on your net taxes for the year. But yeah, I mean, Chris, we unfortunately lost you for a minute. Did you have anything else you wanted to say in that area?
No, I'm not sure where I lost y'all. I was just y'all looking back at me. So
Okay.
we talked
Well, I think
about the CapEx and the OpEx. I don't know where we landed there.
okay, yeah, I think you covered that pretty well.
Yeah.
But I think, look, we understand that sometimes things don't work out as they are on paper. And, this is an opportunity that you could look at. Maybe if this isn't the investment that you have or need right now, there's things you can do about that. At the same time, if things are going really well and you want to explore or expand other opportunities, we can help you with that as well. And I think, there's definitely some projections for next year in the real estate market. I know that Jeremy, you and Rosie did a great podcast recently about outlook for the real estate market on the buy and sell side. Why don't you give a brief outlook review of that for next year?
Yeah. So I don't know if people that are listening to this outside of Indiana know, but maybe if you even live in Indiana, you may not know this unless you really kind of got your ear to the ground about what's happening in the market. But Zillow came out, and I think Redfin came out maybe a month or two prior and officially declared Indianapolis as a buyer's market, which is the first time I think it's ever has happened since Probably the housing crisis. So we've had this huge run where real estate values, kept going up, going up. COVID supercharged it, going up, going up. Interest rates hit, and now we're seeing where the power has shifted into the buyer's hand. So what does that mean? I'll start. What does that mean if you're a seller today or in 2026? It probably means you're going to get a very similar price point as you might have 6 months ago. Prices aren't going down in Indianapolis. Our market's been incredibly resilient. I looked at numbers before we hopped on here, and we had October numbers, and compared to last year in October, prices are up about 2.5%. That's not great, but it beats the alternative, right? And some markets around the country are seeing the alternative where they're seeing prices go down. So prices are staying strong, but what you will encounter is it's probably going to take you a little longer to sell. The days of just going 5,000 above the highest sale comp that your realtor could find and selling it the same day are gone. You're going to have to come out at a very competitive number. And even then, you may wait a little bit. So days on market are going to be higher. Something else to think about is, I guess the buyers have more power now, and they know it, and they're asking for things that they didn't ask for before. So expect to pay some concessions in the forms of closing costs or to help compensate the buyer's agent. You should be familiar with how the whole compensation around buyer's agents has changed now. So you may have to pay more concessions. And then finally, inspections can be ugly now. Those days of waiving inspections, which we saw all the time, are very gone now. And I'm talked to a guy recently that's selling a bunch of properties, and he says his inspection responses are absolutely brutal. Now he's pushing back some, and he's having some success pushing back. But buyers are asking for more. They may be willing to pay your price, but expect to give concessions and maybe pay more for inspection. So while sales prices are trending fine, the net that you get is where things are going to maybe have an impact. And again, in the form of concessions and then inspection. So as a buyer, though, I think it's an absolutely fantastic time to buy real estate for some of the things I just mentioned. Interest rates, even if you talk to someone has no long frame of vision, my son, for example, he's going to be 25 later this month. He thinks interest rates are ridiculously high. Well, they're not. Historically speaking, they're not. The very first mortgage I ever took out was 7 3/8. That was in 1997. But today you can get a mortgage in the sixes as an investor even. And I think it's very competitive. If you buy today, you're going to have less competition out there, and you're going to have more bargaining power when it comes to inspections. So instead of waiting for interest rates to go down even further, which I think they may, all that's going to do is create more buyers, and you have more competition. Prices will start to go up. So I think we're in a great time right now. I think we're almost at a little plateau where I think if you jump on now, you'll be very happy in 2030 to say, I bought in 2025 or I bought in 2026, and look at me now. You probably can't go in ever since Scott and I've been investing at least for 25 years, any 5-year time frame and say it was a mistake to buy 5 years ago. That's never happened, and I don't think it's going to happen anytime soon. So that's what we're seeing on the buy and sell side.
Yeah, I agree with that. That was I've read a few articles that have talked about what happens if interest rates drop too fast. And if they drop too fast, we're competing more with the owner occupants. And we're also probably competing at some point with the institutional investors.
Yep.
Yeah, that's some great information. I think it's something I heard this week. It's if you bought like we did in 2000, yeah, obviously we're very happy today. But if you buy today, as Jeremy mentioned, in 2030 or 2035 even, it's going to be the same potential return. It's just that historically you've seen that type of, like you said, every 5-year period, it's just always steadily increased. Indiana's been a market that's been known for that. We may not have as high of a peak, and we just don't have the lows either. So it's just more steady. And that's been the great thing about Indianapolis for sure. Um, but at the end of the day, yeah, interest rates, relatively speaking, again, I agree, are not crazy high. And if they go down, and once if it's delta has changed, within a half point or even a point, then there's a refinance opportunity you can get, and you can probably have that pay off. So buying now is probably worth it because you have less competition. If interest rates go down, you have that option to refinance. You can't, if you wait till that happens, chances are competition is higher, prices have increased, and you're kind of back in the same boat. So why wait? We went to a seminar earlier this year that said, the long-term projection for real estate investing was to double. And what was it, Jeremy? Another 5 or 10 years?
I think it was like 5 years, yeah, that they expected prices to double. I don't know what he would say today. That was back in April, March. But yeah, the guy that we saw, he was an economist, Harvard educated. It wasn't some hack up on stage. Um, was very extremely bullish on real estate, and basically told everyone in the audience to buy real estate now, buy it on your way home, and buy it when you get home. Was his thing that we, uh,
Right.
and so that was his message. And don't know if I can say it's going to double in 5 years, but um, there's no reason to think it won't go up at a decent clip in 5 years.
Right. Right. At the same time, if it's, this is a tough industry. If it's not for everyone, there are ways to get out, and, we can offer that service. And, a lot of times, in my personal opinion, when you have a performance issue on a property, it's very easy to blame your property manager or maybe your tenant that happened. A lot of times it's just a bad investment. You made a bad choice, not on purpose, I'm sure, but we've had our mistakes. I mean, we've bought some properties that we wish we hadn't bought. It's just kind of when you start doing it as a profession and you do it at the pace we were doing it, not everything's going to be a winner. It's the same in the stock market. Other types of investment vehicles have the same type of risk. So, again, this could be a good time to put your home on the market as well, because the inventory is low, and we have a housing problem as far as the inventory levels that probably will exist all the way out through 2030, as I've been hearing. So, not sure. I don't know if you have anything else to say on that, but
No, yeah, it's affordability is a real thing, and we'll don't want to go into a rabbit hole with a 50-year mortgage. But there's a lot of things that trying to combat that. Um, but the reality is, we all know we have an inventory problem, and we all know housing. Everyone has to have a place to live, and so right now it's a limited resource, and so I have no reason to think it won't continue to go up. So.
yeah. Well, good deal. Well, before we open up to some questions from any audience members, we thought we'd just kind of move on to a kind of a review and maybe like somewhat of a checklist that you can operate with over the next, you know, 2 months and prepare yourself for 2026. So, Chris, why don't you go ahead and kind of review this here, and then I think you can discuss like how, if an owner has a question and needs our help, how that will work with our property managers.
Sure. Yeah. So, reading from the list right here, the year-end checklist. First, let's review our annual income and expenses, prepare for the tax season, verify compliance and insurances, evaluate your property's performance, plan a preventive maintenance budget, identify capital improvements, and set goals for 2026. The client relations teams, again, this is the property managers. Anytime you want to talk to a property manager, please reach out to them. Don't hesitate to schedule an appointment to have these types of conversations. It's really helpful if you give us a little bit of an agenda up front, rather than just say, "Hey, I want to schedule a call," and then we're trying to anticipate what you're going to want to talk about. To give us a chance to schedule that, give us a few days to get that into our schedule and do that review of what you have on your agenda. We're gonna be able to come to you, pretty knowledgeable and help answer. If you just have basic investing questions, we can, probably get those either through an email or through a meeting as well.
Okay, yeah, we have a great new tool that we started earlier this year called Blanket. It's a free and available to all of our owners to sign up with. I think we had some emails that went out earlier this year that invited you to that. If you lost that, want to re-engage with that, we'd be happy to resend that to you. But basically, it's a system, sort of. I wouldn't call it an accounting system, but it's basically a software package that, again, is free for our owners to participate with, but it records your properties. It kind of tracks your asset. It has a connection to our software, so it puts in certain period expenses. You have to update it with some other expenses that are outside of our system, but then it will give you kind of a proposed profit and loss statement. Looks at your equity growth. It looks at the net value of your property. It even has some market analysis and also market options. So it's really a great tool that if you really want to get nerdy with your property's performance, we have that information available to you. So that's out there. Again, yeah, you can recommend to talk, make an appointment with your property manager, and we'll definitely be able to help. I think we can prepare an expanded version of this checklist, which can give like step-by-step instructions of each one of these topics. We can get a PDF generated here in the next week or so, and we can have an email that we can send out with that as needed as well. So I think it's a great opportunity to, again, review how your year went, look at what you want to do next year, and then, of course, handle all the IRS stuff for government, make sure you're on the right side of that. But yeah, do we have any questions? We can go ahead and open it up to questions now. Chris, if you want to monitor that while we're waiting for any questions. Jeremy, do you have any additional information or points you wanted to make sure we covered?
Nothing new. I think we've covered a lot of things here today. I'll just go back again. Real estate investing isn't fun every day. We totally understand that. I just mentioned Scott and I spent $40,000 this year on HVAC. It happened over 6 or 7 different properties. I don't remember exactly. Those are never fun days to write those kind of checks. But doing the personal financial statement, doing that year-end spreadsheet I mentioned, those are fun things. Those are what makes real estate exciting. It's what keeps Scott and me going, because we see the equity build up. We see it every year. And so that's to me, the real fun part of it. So big advocate of doing that. If you have any questions about that, I'm happy to talk individually with you about how we look at it and how we prepare it. It's pretty straightforward, to be honest. You can probably use ChatGPT or Google to find out the best way to create your own personal financial statement. But again, those are fun. And if you set it up as a recurring event each year, at the end of the year, beginning of the year, whatever it is, I think you'll have fun doing it.
Yeah, I've had a lot of fun putting together that personal financial statement. We started doing that last year, and it's really fun to see that progress. I also ran across a retirement plan that somebody put together for us when my oldest was, firstborn, and she's 22 now, or on the verge of 22. And just being able to look back is a lot of fun.
Yeah.
We do have one question. It's a general question. It says, is there any part of Indianapolis area that TNH does not serve? And if so, which areas? That's a big question. Jeremy, you want to kind of summarize that one?
So I mean, theoretically, we manage all of Indianapolis, all right, all of Marion County. We have properties in all parts. If there's a medium to large neighborhood in Indianapolis, we manage in it almost certainly. We are more concerned about a couple of things. One, the type of property. We like long-term leases, right? So we don't do short-term rentals. We don't do mid-term rentals. So if a property's set up as a short-term rental, mid-term rental, we're not the best solution for that. There could be, and Jake Knight's our business development manager, and I encourage you to reach out to him if you have a specific address in mind. I can't say we would take on every property. If you're an existing client of ours, which obviously this person is, because they're in this webinar, we do have a little more flexibility that way. But generally speaking, we manage the whole thing.
Yeah, I mean, I can't think of any areas that are completely off limits. I mean, I think some of it has to do with condition and intent. Like if you want to be, I mean, and I hope there's no clients that are like this, but we are not going to be on the lower end of the market. We don't specialize in the lower end of the market. There's a whole set of parameters and people that do niche in that, but we are, suburban specialists. We higher end rentals, especially. But we're going down to, some C-class properties. But really, that's the limit. It's really the condition of property. I mean, so
Yeah.
it has to be C-class or better. We don't do D and or anything lower. So, all
Next
right.
question we have is what kind of recommendation resources would you recommend for new investors in real estate, especially for single family house turned into rental property? I'll kick this one off. I've been working on developing my investment knowledge over the last 8 years, and something that I keep finding myself gravitating towards is Dave Meyer from Bigger Pockets, his podcasts, or I guess webinars, whatever you want to call them, as well as his books. There are two books that I have there's one in particular called By the Numbers that really gives me a quick handy guide for numbers, for the RI, ROEs, things like that. And then also he has a book called Start with Strategy that I am still working through. There's a workbook that comes with it as well that is really helps you shape your vision. Um, Anybody else have any suggestions or any thoughts?
Well, not to toot our own horn, but we have, one of our core values is, advising and educating. And we put a lot of effort in that. I mean, we have podcasts, blogs, YouTube channel, a lot of videos out there, a lot of information out there. We help, and I think we're always willing to try to do that. And so if you subscribe to all those different channels within our company, I think you can get a lot of information there.
So, and Brooke, I know Brooke's in the background here. I don't know if she can maybe throw down a link to our blog and our podcast, maybe our YouTube channel. I don't want to make you copy and paste too many things, but it could be helpful to put those in the chat. But Chris, it was about converting. Was it converting just a residential home that was lived in by owner occupant into a rental, like best practices? Is that the question?
Yeah, it's really about as an investor who has a single family home turned rental. It's just what I would call that beginning part of the investor journey specific to single family homes.
Okay. There's a lot there. I mean, if they're converting a personal residence, like Scott mentioned, we've got really good content around converting a personal residence into a rental home. If it's the kind of things you need to do before you start buying, we have content about that as well. Creating the buy box, setting your goals, making sure your team is around. You have to have a really good team. I talked to a guy on our podcast, I think came out yesterday. When he first started investing, he had a bad team and he suffered for it. His investments, really went negative on him. But I just think, again, that CPA, the property manager, there's a good lender, insurance people, mentors. There's so many things that you need to do to kind of really set yourself up for success. And I think it all comes back to treating it like a business, because that's what you're doing when you're a landlord, whether you like it or not. You are a business owner and you have customers in the form of residents, and your product is your home that you're trying to, get rent for, and you need to make it safe, attractive, things like that. And there's a lot that goes into that, but that's kind of the starting point.
Well said. Yeah. Well, unfortunately, we're running out of time for today, and we do appreciate that. Matthew, real quick, can you just hit the timelines for 1099s and year-end statements again, just so make sure we get that covered?
Yeah, absolutely. Again, this will be communicated out, so make sure you keep an eye on our newsletters. But just really high level annual statements, that's January 1st through December 31st for 2025, will be issued on or possibly even a little bit after January 5th. 1099s will be hitting your inbox. Those will be coming from Track 1099, which is a service we utilize. That'll be hitting your inboxes, your email inbox, January 31st. please review those right then, because we do have a little bit of period of time before we have to submit it to the IRS. That's a great time to make edits and changes if we have to. So please, January 31st for 1099s, January 5th for your annual understatement.
All right. Well,
Yeah,
and of course, if you, oh, go ahead, Chris.
sorry. There's one other question here. This is from Michael. Since we're short on time, Michael, I'm going to reach out to you directly on this one. He's asking about his Fisher's tax bill, the cost on that, and if there are locations that may be better. I'm a Fisher's resident myself, so I have some things to say.
Yeah,
All right.
we've done a lot of blogging on taxes. We know it's a really
Yeah.
pain point, but it's unfortunately part of the game here. But yeah, of course, if you have questions in general, your property manager is a good resource. Book time with them, reach out, look for our newsletter, our podcast, etc. Hopefully that gave you more information as well. So again, thank you for joining us today. We appreciate your continued partnership, and we hope this information has been useful. So until next time, please stay invested in your investment.